today, but since you already made it, so you're going to be warm and cozy, right? Now, this room is part of our larger campus. Right across the lot from this entrance, I believe, is the Arch Street Waterfront Pavilion. It's a nice little space. It has my favorite thing, food, and also the thing I cannot live without, charging stations. You can also hold conference calls there. I know it's a market. Market is open today, so you may need to take a call there. It's a perfect space. And also, in case you still don't want to miss anything going on in this room, there are television monitors like the ones you see in this room, so you won't have to miss anything if you don't want to. Now, we have many great panels lined up for the rest of today. I'm sure that's what all of you are here for. Some of these panels will be recorded and streamed on our forum's official media partner, CNBC. Welcome, guys. These are their cameras. I'm a television host. Here's my title. I am not on TV today. However, I will run today's show like a live show, meaning if you're on a panel, please be on time. Please be mindful of the time. We have so many great speakers today who are industry thought leaders, and believe me, you don't want to be that person to cut other people short just because someone else is scheduled to speak behind you, right? All right, so we're going to try to stick to schedule as much as possible. All right, I'm done talking. I would like to welcome one of the guys who made today's event possible. He has worked on this event for months. Let me introduce the co-founder of the Greenwich Economic Forum, Bruce McGuire.
Thank you, Julia. Good to see so many friends here. It's always great to see friendly faces. So I actually have an easy job. As Julia said, my work was done over the last 6 months. And so my job right now is just to kick things off and then get out of your way. But I do want to acknowledge some of the people that were instrumental in bringing this event to life. So, and tell you a little bit about the vision. So, you know, in our thinking, New York and Greenwich, you know, that corridor is home to the highest concentration of thought leaders and influencers anywhere in the world, we believe, particularly but not exclusively in finance, and with Greenwich known around the world as the hedge fund capital of the world. About a year ago, two of us had the idea to harness this wealth of talent that we have in this region and to produce an annual summit where global thought leaders would descend on our beautiful town of Greenwich for a 2-day summit to share their wisdom and exchange ideas with all of us. Many of you here in this room are accustomed to jetting off to Davos for the World Economic Forum or going to LA for the Milken Institute. Our vision is to join that illustrious grouping and to create an annual event where the world comes to visit us here. And so this is why we're gathered here today. There are some people, you know, this was an idea, right? And it takes people to kind of to buy into your idea and to lend critical early support. So there are a couple of important people that I need to acknowledge who lent that type of support to us. The first is my co-founder, Jim Aiello, who as chairman of the Mayor's Economic Advisory Committee gave this idea a full hearing and then lent his immediate and full support to the endeavor. The second is our mayor, Peter Tessie, who opened up his Rolodex, literally, for us, and also tapped into the rest of the town of Greenwich and put the resources of the town of Greenwich at our disposal. The third is our Department of Economic Development Commissioner, Catherine Smith, who bought into our vision early on and lent her enthusiastic support at a critical time in our formation. And so, really, it takes people with vision and courage to get any new endeavor like this off the ground. And this couldn't have happened without their critical support. We also, in addition to some of the key individuals, we had early and material institutional support. Our institutional partners that came in early, bought into this vision and came in early, include Bridgewater Associates, Balyasny Asset Management, RockCreek, AQR, CNBC, as you see, CNBC is here. And then our sister city friends at the Yuhuan Shannon Funtown in Hangzhou, China, where Greenwich has a sister city relationship. And to my Chinese friends, Ni hao, Huang Ying, Guan Lin, which should mean hello and welcome, and I hope does not mean that I am a jelly donut, or something like that. So please join me in a round of applause for our early supporters and adopters. And now, a little departure. To show that we're more, and again, the vision here is to create something that over time is more eclectic than even just an economics conference, and to show that we're more than just people that are going to be talking about federal funds rates and earnings reports. We are now going to show a short work of contemporary video art from Ukraine. We'd actually tried to get Vladimir Putin, but he's still busy with the Florida elections. So we've got a video from Ukraine instead. And this comes courtesy of the Greenwich Art Gallery of Zoya Fine Art. So thank you to them, and we will cue the video, and we'll just have to turn to face the video screens.
Well, I know Bruce likes to think his work is done, but I would say he's still very much the problem-solving guy today, taking care of everything from front to back. If you don't like something, by the way, you're welcome to complain to him. The coffee is too strong, whatnot. If you like something, you can just direct a compliment to me. All right, I wanted to hear a few words from our city's representative, the mayor of Greenwich. Actually, I'm from California, and I did not know, as of 3 days ago, it is not called mayor. Right here. He is officially the first select man of the city of Greenwich. Welcome.
Good morning, everyone, and welcome to Greenwich, Connecticut. Today is an historic event. It marks the start of the inaugural edition of the Greenwich Economic Forum, which is bringing together some of the brightest and most innovative minds in business and finance. The video that we just saw probably has left some of you surprised, maybe even perplexed. What does it have to do with the important dialogue that we'll be having during the next 2 days? Well, this 90-second work of video art by Daria Zuravel, which was produced in collaboration with our own Greenwich Gallery, Zora Fine Art, is not merely a creative product to indulge and entice the eye. Rather, It's meant to be symbolic of the vast technological changes we experience every day. They are experiences that meld technology, finance, art, and science into our daily lives, that provide vast power and resources that we must use responsibly to ensure growth and prosperity for all. You may be familiar with the quote at the beginning of the video, Paul Tudor Jones' perceptive and prescient words, "No man is better than a machine, and no machine is better than a man with a machine," are worth reflecting on as we begin this forum this morning. In the mid-1990s, with the dawn of the internet age, few people understood that we were being thrust into an era of unparalleled technological innovation and progress. In fact, it could easily be argued that there had been more innovation during the last few decades than in the previous 100,000 years of human existence. It is an understatement to say that we are navigating uncharted waters, and no one has any idea where this new era of innovation will lead us. Among the questions to ponder and consider are, will the machines take over? Will our children be plagued by mass unemployment? Will environmental changes be our civilization's downfall? The power of the internet and other technologies has led to the creation of an extensive web of global integration and interconnectedness. This has fostered a world of unprecedented opportunity for rapid development in virtually every corner of the planet. Any idea or innovative technology can now be adapted quickly and utilized by any society, whether that society is already highly advanced or it is traveling the path to modern development. Today, with the aid of technology, the world is truly flat in terms of opportunity. As you all experience every day, technology is changing the landscape of financial services, while finance is changing the landscape of technology and innovation sectors. The people gathered here for the inaugural Greenwich Economic Forum are responsible for managing more than $4 trillion every day. I'm willing to venture that most everyone is asking themselves, how will technology impact the financial services sector? And in turn, also wondering, how will investment strategies impact the development of new technologies? Today's global web is highly complex, fragile, and vulnerable to unintended consequences from seemingly unrelated events. Political risks are mounting. Economic risks such as financial tightening, volatile capital markets, and trade protectionism pose challenges for even the most sophisticated investors. Add to these risks technology disruptions such as cryptocurrency and algorithmic trading, and we have a recipe for potentially treacherous investment environment. But does this mean that we are intimidated by the challenges we now face? No, not at all. In fact, we embrace the challenge to improve this modern world. Technological innovation will be the key to our success in the future. For example, from stealing and destroying jobs, I envision we will see technology will open up exciting new professional horizons for the next generation, which will foster incredible investment opportunities for financial institutions. The Greenwich Economic Forum has brought together 300 of the world's leading minds in finance, business, and public policy to discuss and debate the global risk environment. It is our hope and expectation that conference delegates will gain a better perspective of global risks and acquire tools and techniques to deal with them. Throughout these 2 days, you will have access to some of the best minds, not only locally and across the country, but globally, who will provide you with the very latest information and insight into this rapidly changing investment landscape. Whatever you take away from our forum, there's one thought that I want to leave you with. Regardless of what the naysayers may say, and there are many, let's look to the future with optimism and hope. A study of history clearly shows that mankind has always been plagued by upheavals and crises. And what gives me optimism for our era is that unlike previous generations, we have at our fingertips the immense power and potential of technologies that we ourselves are only beginning to understand and fathom. I'd like to thank everyone who has helped make this Greenwich Economic Forum possible, from the moment of conception more than a year ago to the last-minute efforts to finalize all of today's preparations. A special mention go to the First Selectman's Economic Advisory Council and to Ray Dalio, who from the beginning embraced the concept for this forum and has supported it right up to today. Ray has been an enthusiastic champion and supporter of the forum, and without his effort, we may not be here today. Thank you, and may the inaugural Greenwich Economic Forum inspire and serve you all well.
Thank you, Peter. All right, the other representative we have in the House from the town of Greenwich is Ms. Catherine Smith. She is the Commissioner of Connecticut Department of Economic and Community Development. Come on up.
Good morning, everyone, and welcome to Connecticut for those of you who come from far and wide. We are so delighted to have you in the state, and I am particularly happy to welcome this group to this really important event. And you heard from Bruce about the early seeds and the idea of this, and we were very pleased to be jumping in to help out because this industry, the investment industry, and in particular hedge funds, have been such an enormous part of our economy for so long. And we have incredible companies here, companies that are investing in the state every day, and they're hiring people here and growing their presence in Connecticut. And why Connecticut, you might ask? Well, I think it's in part, you saw that interesting video about the confluence of art and technology. And Connecticut has always been an innovative state, leading in innovations in aerospace, in things like inventing the sewing machine. You name it, we've been inventing it here, including in terms of investment types of products. So we think this is a great place to bring together the greatest minds that are then surrounded in our community by the great minds that work and live and play in these environments every single day. You know, Connecticut is ranked as the third biggest state in the hedge fund industry after New York and California. And oh, by the way, they are a tiny bit bigger than Connecticut in terms of population and everything else. So we're pleased to be in their neighborhood, if you will, in terms of the size of the industry here. But it's really about the quality of the industry that I think is so important and is really represented by the work that's being done today in this room and by the companies that are here. So we're grateful to Bridgewater, to AQR, to the other many, many companies that make Connecticut their home. And I'm also very grateful to Bruce and Jim and Peter for being the sponsors of this terrific event. And I look forward to having a chance to visit with all of you in the next day or two as we really learn more about what's happening in our interesting world. Thanks so much.
Everyone who just arrived, there are more seats on this side of the room if you wouldn't mind making your way to this side of the room. Right there are more seats. All right, now I have a question for everybody. Does any of you know Ray Dalio? Would you like to hear from him? Come on up, sir.
Well, I'd like to welcome you to the greatest town in my home, the greatest town, Greenwich, Connecticut. And there's a reason that Greenwich, Connecticut, there's a reason it's the center of hedge funds. There's a reason that it's such a great community. And the reason I also want to welcome you is that I look out on the audience, and I have friends here that are neighbors. And then I have friends who are from China. I have friends from Abu Dhabi. I have friends from Singapore. And that's the essence of the place, right? In other words, it draws. It's right next to New York City. It's this fabulous bucolic place and great education. It's just such a wonderful town. So welcome to the town that I'm so proud to be part of. And I hope that you make yourself at home, and I hope that we can give you some great hospitality. So that's the main thing I wanted to do here, other than have an interesting conversation. So welcome. Thank you very much.
All right, and Ray's going to be part of our first panel. I'm going to kick it off right here. We're going to talk about something very topical. Obviously, the global landscape is changing. Earlier, our speaker talked about the changing political climate, trade protectionism, and just the broader question we ask, what's going on, and what are some of the ways we can invest, and where are the opportunities? So with that in mind, I will hand it over to the moderator, who really needs no introduction, Leslie Picker of CNBC. Take it away.
Thing is on. There we go. If my fellow panelists want to come join me up here, that would be wonderful. Thank you so much for having us today. I think it's, you know, as you read the title of today's conversation, navigating global markets in a world in transition, seems to be few times as opportunists today that fit into that category. So with that, I'd love to kick it off with you, Ray. You recently wrote a book looking at big debt crises, and I want to read you an excerpt from that book because the contours that you describe sound familiar. While tops are triggered by different events, most often they occur when the central bank starts to tighten and interest rates rise. You go on to say, the fastest rate of tightening typically comes about 5 months prior to the top of the stock market. Unemployment is normally at cyclical lows, and inflation rates are rising. So are we beyond the top? Are we there? Are we at the top? What's going on? These are your words.
Yeah, so in answer to your question, we are... Oh, I'm sorry. Thanks. You're welcome. Nobody's ever sure of the exact time of the top, but I think it's clear that in a cycle, that, just to clarify the cycle, there's productivity over a period of time. How we invent, learn more, how we produce more output per man hour is the most important thing in raising our living standards. But around that, there are two cycles. There is a short-term debt cycle, which we call the business cycle, which I was describing. And very classically, when there's excess capacity, you're in a recession, central banks stimulate monetary policy, and then you go up until the point where interest rates are down a lot. When you push interest rates down and you make the economy, and now quantitative easing, buying assets, you buy $15 trillion of assets. All of that causes the asset prices to go up because all assets compete with each other. Private equity, everything competes with each other. And then you have that interest rate built into all asset prices. In other words, an investment is a lump sum payment for a future cash flow, and we have a discount rate. And as you start to raise the discount rate faster than is built into the curve, what is discounted, then you start to hurt asset price. And then you make a competition between the short-term interest rate and the longer-term interest rate, or the expected return of other asset classes. And that, when you look at that, like you have a flat yield curve now, you change incentives, you change the pricing of asset prices. In our particular case, we also had a corporate tax cut. And a corporate tax cut is very beneficial to owning equities, so that's a boost. It's sort of a one-time boost into terms of the economy. And it then also produced a stimulation, which has taken place when we have a limited amount of capacity. At the same time, we have to sell a lot of bonds to finance the deficit. So we're in a position in terms of that shorter-term debt cycle that we are very late in that longer-term debt cycle, right? The upside risk-return has changed a lot, not being as advantageous as it was before. What concerns me beyond that is that we're in the later stages of a longer-term debt cycle, which I mean is everyone wants assets to go up. Everyone wants the economy stronger. And you want to provide demand. And demand is produced by providing credit. And so everybody's sort of leverage long. In other words, you own businesses, you own real estate, and you have an amount of debt. And by lowering interest rates and pushing money out into the economy through quantitative easing and so on, you push asset prices. So if you have a downturn, there's not as much ability for that downturn to be dealt with effectively with monetary policy. So that also has made the risks asymmetric. In other words, we could take a look at where we are later in the cycle, and then also when you think beyond that, we have issues pertaining to what if the economy were to turn down. There's also the geopolitical issue is a big issue, internally and externally. because of the polarity that exists in wealth. We have wealth and opportunities and so on. We have an internal conflict, populism, in terms of state is a representation of that. And then we have, and that political risk is a concern, I think, that would be if you have a downturn. So all of those things means that the risk return for equity markets or assets has shifted.
So, Afsaneh, I want to turn to you, and just by way of introduction, Afsaneh Beschloss, founder and CEO of RockCreek Group and formerly at the World Bank. So with that background in mind, what kind of policy implications do you see kind of in light of Ray's comments about where we are in the cycle? I mean, is it something where, we've already kind of done the tax cuts as the stimulus there, so there's not much we can do in Washington to really stimulate the economy if we do fall into a recession or a depression? And then is negative interest rates an option for the U.S.? I mean, how do you kind of look at the different tools that policymakers have in their toolkits right now if we were to indeed reach the end of the cycle?
So I think we're at a very interesting, does this work? I'll borrow Ray's. I think what is really interesting is two things that were really, really incredibly different than if we look at sort of the history of our economy over the last couple of 100 years. One is what Ray mentioned, which is post-2008, the amount of liquidity that came into our economy was unprecedented. The second thing that happened during the same period is really what happened with China. That rate of growth that we saw in China and the injection of local capital that happened in China also was unprecedented. So I think we are now at sort of the end of that cycle coming, as we just heard also from Ray. But the other way I look at it, we happen to have Alan Greenspan as a senior advisor to RockCreek. He sits next to my office, and we talk all the time. And he has a book out, which CNBC had a nice interview with Alan on that. And he sort of looks at the history of the last couple of hundred years in our economy, showing really constant kinds of relationships between the markets. So while a lot of new tools exist today, and a lot of people in the room use a lot of the new tools that didn't exist maybe 30 years ago or 50 years ago, the relationships between the markets have not really changed. So as a result of that, I think going back to sort of broad policy, my thinking is that right now we are at while we are at a point where equity markets are seeing a different kind of sentiment, we're seeing leverage in the market starting to change. At the same time, one part of the equation in our GDP has been left behind, and that's wages. So if you look, I think two things that will be changing over the next 12 months. One is interest rates still going up. This year and next year, I'm in the camp that they will go up the full 5 times 25 basis points. Number one. Number two, the wages also will be changing, and we have had unprecedented also wage stagnation. So those two things will potentially lead to a stagflation scenario later on in this cycle.
And are we able to deal with that? Do we have the toolkits to deal with that, or because we have kind of expended our resources and, you know, we're in this kind of unconventional monetary policy period, even still as rates are rising, does that limit our ability if we get into a situation in the economy that isn't as favorable as it's been for the last few years or so? So
the U.S. dollar and the U.S. economy and U.S. interest rates have been the dominant part of what determines everything. I think on that front, you know, we even heard from Jay yesterday, Jay Powell, saying that you know, there are some interesting new signs in the economy. So there is a scenario where interest rates might go up, but then get corrected faster. And those changes up and down, you know, we're so used to this 25 basis points orderly change. If we go back, not a very long time ago, we could have, you know, interest rates get adjusted down quickly and not necessarily by 25 basis point blips. The other thing I really think that global impact of what's going on in China and what will start happening to Chinese currency, Chinese markets, the role of Chinese equities in total equity markets, and what they do with their interest rates will become much more important part of the conversation than it is today.
Now, Dmitry, I want to bring you into the conversation. Dmitry Balyasny, the CEO of Balyasny Asset Management. What indicators are you looking at that can help you kind of suss out where we are in this cycle? Is it volatility? Is it valuations? You know, what are some of the key metrics that you're looking at to help figure out kind of how to position your portfolios?
Sure. I mean, so market calls are obviously not that easy to make, and they're not a super high sharp business for us. But the best indicator that we've had over time is just the bottom-up information that you get from speaking to lots of companies all the time. So our largest business is fundamental equities, and we have a couple hundred folks involved in the research there. And so you have thousands and thousands of conversations with all the companies that you cover on a regular basis. And over this last earnings period, you can hear the tone kind of changing, on the earnings calls and outside from companies where there's definitely a lot more caution than there was before. And so part of that is kind of classic late cycle stuff where you have rates going up, you have tough comps that were juiced by the tax cut last year, and you've had a beta chase and sort of balance sheet levering in a lot of cases over the last 10 years. And then the thing that's recently kind of causing confidence issues is the trade tariffs, where it's debatable how much companies are kind of front-loading their orders to try to get ahead of the potential increase next year if that doesn't get resolved, and just uncertainty of having to kind of re-engineer supply chains and not sure how long it's going to take to play out and how it's all going to work. I think does affect corporate confidence, right? And so it's starting to bleed into a little bit of less capex as opposed to a year ago when we all thought that you were going to get like a lot more capex. And so that's, I think, what the markets are struggling with, layered in with higher rates, and all the other issues that we kind of all know about.
Are you getting the sense that there's inflation really trickling in, beyond what we're seeing with some of the economic indicators? A CNBC data scrub recently found that about a third of companies in the S&P 500 mentioned inflation in their earnings calls, up 7 percentage points from the 10-year average.
Well, inflation and hedge fund compensation is coming down. So that's topped. The rest of the market, it's hard to say. There's definitely cost inflation from shipping and different parts of the supply chain that you see start to affect companies over the last year. But I would say from what we've seen, we haven't seen it much more broadly than that yet.
Well, you also brought in the topic of geopolitics and tariffs and things like that. And I want to turn to you, Ray, because in April you opened up a Chinese version of your risk parity fund on the mainland. Does the trade skirmish change your calculus at all in doing business in China? How do you think about building a global business in a world where, as you've written about many times, it's increasingly protectionist? What types of strategic changes have you made as a result of all this, if any?
It works. I've been going to China since 1984, and I've had the pleasure, the honor of being able to participate in knowing the people, knowing the policymakers, and that whole evolution. And I think this goes way beyond trade issue. There's a trade issue. I think you can get past that. I think that because China's been tremendously successful and continues to be very successful in many different ways, it has become a competitor in the world in all different ways. So I think it has to do with more of the differences in the approaches. I think the trade issues can be handled. I don't think that the different ways of being issues can be handled so easily. And one of the Chinese leaders described it to me. He was saying, said the essence of the difference between Americans and the unit that they value and the Chinese and the unit that they value is that the Americans value the individual and its individualism, and with that, individual property rights and so on. And in China, well, we value the family. And the family, so if you think about family, they said the word country in China is two characters, which is state and family. And what that means is that it is more of a paternal type of operating. So if they're going to, let's say they're going to think you need to build a road in a certain direction, and in the United States they may have property rights issues that stand in the way of doing that. There they would say it's the whole community that matters. So this, the basic difference is a top-down versus bottom-up. So if you take, let's say, the 2025 plan or something, where there's a vision and a top-down vision that we're going to build out the country this way, they will coordinate the parts of that vision in terms of having different parts. And it may be the tech companies, and maybe it's the military, and maybe it's all of the parts in pursuit of that mission. And there's a 2025 plan. In the United States, it's very much more bottoms up. So if you were even to take things like video games, I think it's a good example. We would never think that the government should control whether there should be video games, how our children use video games, or matters of education. We have educational challenges. That becomes a bottom-up issue. And in some cases, from a Chinese perspective, they will not want their kids to play that amount of time on video games. They would want to limit it. And so when we're dealing with really ways of being issues, and then you're dealing with that with the geopolitical various other issues, it's a real question of how the two countries will deal with each other. History has shown there's a concept called the Thucydides trap, and anyway, don't worry about it, how it got its name. But the idea is of when you have an emerging country that's a competitive, strong country competing with an existing power, that there's a risk of conflict. In the last 500 years, there's been 16 times that happened, and in 12 of those times there's war. And so the issue of conflict and how we approach that conflict is going to be an important issue, not just geopolitically, but it will go back to issues like supply lines. Because if both countries feel that they are competitive, then they think, well, where am I going to produce it? If in the United States you produce your computers in China and then you bring them back in the United States and there's a conflict, then that's a vulnerability. Or if Chinese invest in the United States and they think that could be sanctioned, that's a worry. So I think that this issue is going to be an issue with us that's a long time, and it's going to be significantly beyond just the trade issue.
And yet you're expanding your business there.
I think if you look at the country in terms of productivity, as I said, there are these cycles, and China's going through its cycle. But I'm very optimistic for the longer-term productivity of that. A bad year in China is going to have twice the growth rate as a good year in the United States, by way of example, right? And so, and I have a tremendous amount, really, of respect for the intelligence and this development. The new China has an energy to it. They have changed what the environment is. The old communist environment and state control is no longer the case. In terms of like entrepreneurship and energy, it's a very, very exciting place. So, I'm excited about China. I can't understand how anyone couldn't be excited about China. There's a rivalry, and how we each deal with that issue is an important issue. But it's an exciting place. I love the place.
Afsaneh, what do you think about emerging markets, especially this year where just an ETF, for example, that's a proxy EEM, is down about 25% from its January high this year. We've seen, pockets of turmoil in Turkey, and obviously there are talks of other emerging market economies slowing. How do you play these markets these days?
I've been involved in emerging markets for more than 30 years, and as you said, what has become very interesting is in the initial period when we all started looking at emerging markets, there's a lot of inefficiencies. So it was easy to get the return. So we look at 20-year returns, 15-year returns, the returns were pretty high. But the volatility also of these markets were much, much higher. As we sort of come to the last, again, few years, we talked earlier about what's been going on in the U.S. in particular. A lot of these countries did leapfrog, and they continue to leapfrog. So on the positive side, the leapfrogging that we saw happen with telecoms and telephones and cell phones is something we're seeing now in emerging markets happen in the medical field, in technology, in the number of entrepreneurs we see, and not just in China, but the rest of Asia and in many, even in Africa, with payment systems getting reformed because they don't have a proper banking system. So those are the positives. The negatives are obviously what we've seen, particularly in the last few years, really. If we look at emerging markets, this year was a bad year, but the last 5 years, given what happened in U.S. markets, let's say, the relative performance of EM was not great. The relative performance of Frontier within EM, which is supposed to do better given the greater risks, was even worse. So I think those were partly related to what happened to these countries, but also partly happened to what happened in our economy on a relative basis. I think what's more interesting is looking forward. As our interest rates are going up, obviously there's some negative impacts. We saw what happened in Turkey. We saw what happened in Argentina. Despite the reforms that their leadership had made, we saw a major correction because maybe those 30-year bonds were a little too much too early in Argentina. So I think what we're seeing is the cycle returning in emerging markets. They probably have some of the best valuations you've seen in emerging markets in a very long time. But we haven't seen the trigger point. I think people are still concerned about the risks in these markets. There's sort of still a question whether I should still stay in U.S. markets another 6 months. Is it another 3 months? Is it another year until that relationship changes and people are more excited about the PE ratios in emerging markets, really across the board. I think one last point I should mention, China is starting to become its own separate market. Technically, China is part of the emerging markets, but the way it's behaving, the way the size of the market is growing, it is really becoming its own very separate market, and I think we should look at it in a different way than we have in the past, and it will probably have its own place in the various benchmarks out there.
Great. I want to turn the conversation to the hedge fund industry. I know it's one that's near and dear to the hearts of the three panelists who sit beside me, as well as many people who are also in the audience. Dmitry, beginning with you, you've said in the past that there are too many assets in the industry, and that's a complaint heard by a lot of hedge fund managers these days, that it's making it difficult to generate alpha when you've got all of these assets chasing the same end. Do you think that we're going to see an inflection point, especially after some of the return numbers from October? Are you seeing a change in the industry that could indicate that it may make it easier for hedge funds to, once again, deliver the alpha that they're striving to do?
Yeah, I mean, I just think of it this way. So there's $3 trillion of AUM roughly in the industry. So if you make the assumption that most of that AUM is there seeking real uncorrelated alpha, you need about $500 billion of gross P&L dollars of alpha generated per year to make people relatively happy, right? And I don't know how big, the alpha pie is, right? It's difficult to generate, to estimate, but I know it's not $500 billion, right? If I had to take a best guess, I'd say it's closer to a tenth of that, right? Of true, if you take out all the factors, you take out all the beta tilts, you take out, sector leans, and you just look at real bottom-up alpha or trading-oriented alpha. So that means more and more people are basically fighting with each other on a professional basis to try to capture, pieces of that, right? And that just makes the markets and all the various strategies more efficient. And so the industry is going through this period where it's a consolidation. I think it's just going to accelerate, where you constantly have to, run faster, be smarter, innovate, hire better, develop better, add technology, add data, in order to be able to compete and win as the overall industry consolidates and you fight for a smaller pie with more people fighting for it. And I think over time, as you kind of come out of that, and different strategies might come out of it at different times, when those strategies come out of that period, it's a very fruitful alpha environment, right? Because you have less capacity fighting for the same type of trades. But when there's regime changes in between, combined with like a macro regime change, what's going on now, and you overlay that with too much capacity, pretty much every strategy in the industry, you get pretty poor performance, right, as people degross their portfolios. And as that works its way through the system, at some point you come out on the other side of that and you have a fatter alpha opportunity for those who've done a good job of managing through that.
I would say I see that differently. I think alpha is zero-sum, right? So hedge funds as a whole, you could say mutual funds, you could say any group of investment as a whole is zero-sum. So alpha, I don't think we could talk about the total alpha, because I would say at the end of the day, there's not going to be much total alpha. It gives you the freedom, what the hedge fund does is structurally give you the freedom to be able to go long and short, to be able to take spreads, to be able to balance portfolios in another way. And so, and I think the environments, there are stronger, better environments for alpha, generally speaking, more volatile, but also the issue of distinguishing oneself in a bear market. In other words, most assets are, if you're taking alpha and you could put it on top of portable alpha, you can put it on top of any alpha in the asset class. So I think that there's alpha producers, and the question is, what asset class do you put it on? Because it's compared with this assets that when there's a bull market, then it suffers by the comparison of a bull market. But then there's the down market. I think the world, by and large, is leverage long. And so I think the real question will be how much diversification exists in other portfolios when you have a bear market. And that will be the opportunity to distinguish those who are able to extract alpha from those who aren't. You get into a bear market or a market of volatility, I think that's the issue. I think most investors right now are leverage long. If you say where the market is, it's leverage long. So I think that's you have to create differentiation without much beta being built into the portfolio. That's why I think portable alpha on top of whatever asset class you have as a strategic asset allocation is a better approach. Any investor should have a strategic asset allocation mix. In other words, what will be the neutral portfolio that you'd hold over a period of time, and then try to seek whether there's alpha, and that should be a zero-sum game, and it'll distinguish the winners from the losers, I think.
I was going to sort of take a slightly historical perspective on this. If we look at the history of hedge funds, I think when I was at the World Bank, we started investing in hedge funds. In fact, my predecessors started investing in hedge funds, and Ray can correct me if I'm wrong, but they claimed that World Bank made the $5 million first allocation to the fund. Is that true or not?
Yes, it was. My first account was the World Bank. They gave me $5 million in 1985, first institutional account. And I thought, wow, that was an enormous amount of money that I had $5 million.
Right. So it is true.
Yes,
so people have talked about that for years. So I'm glad. Exactly.
And of course, we know each other.
Of course. And then right, of course. So, and then, so moving sort of straight along, if you remember, it was initially macro funds. That was sort of the early forms of hedge funds. And then we got many other strategies get added on over time as market inefficiencies developed in different areas and different instruments got created and expanded in the markets. So you had long short, you had vol strategies, you had credit strategies, you had merger arb strategies, convert strategies, so on and so forth. So in the early days, it was really high net worth investors, it was the family offices, and it was endowment foundations and people like us at the World Bank who were investing in hedge funds. So, so that was a small market, and it was basically people like Ray and other people who were starting their hedge funds, a lot of their own money, and you went along for the ride. And that the 1% or 2% was important, but it was that incentive fee that really motivated people. Fast forward, I think another one of my friends who's in the room, Mark Anson, who was at CalPERS at the time, and he was one of the first forces of large institutions getting into hedge funds. And what we saw really post-2000 is the size of this industry expanding hugely. So while we were a couple of $100 million, getting to maybe 500, 800 billion in this market, you got this market to double in size over a very short time as these large institutions in the US and then later on the sovereign funds started coming in. And everyone was looking for an institutional form of hedge funds. And at that point in time, a lot of the industry started becoming more like the rest of the asset management industry, which was looking at the fees, which became important. And you were not necessarily investing in a fund where the founder was investing, all of his own or her own wealth in that fund. Fast forward, what I would say is now, as Dmitry said, we have $3 trillion in the market. That has almost doubled, by the way, in the last 10 years. So even though we're saying hedge funds have gone through so much difficulty, even post-2008, it's one of the sectors that's increased the most. But like everything else we talked, everything else does go in cycles. And for everything that you get paid, you have to produce value. So we might be moving a little bit closer to that original idea of hedge funds, where there are people who are starting funds. While we saw a lot of negative stories, people closing hedge funds, a lot of funds that started this year with founders putting in 30, 40, 50% of the capital and investors going in. And the other side was founders closing down their hedge funds like Highbridge and basically moving to family offices. I think we'll just see a lot of dynamic movement in the industry. And I think the positive and the negative of the hedge fund industry has been that it is dynamic, it is moving, and you get a lot of births and deaths.
But
I have like 2 comments to add to that. One is the World Bank should have definitely negotiated a seed deal with Ray. I don't know what happened there.
Agreed.
Two is I totally agree with Ray that I think a bullish environment, right, and asset classes generally uptrending for the last 10 years kind of masks a lot of performance issues, right? So most investments have a bullish, bias to them. So whether you're looking at, credit investments, private equity investments, venture capital investments, fundamental equities and hedge funds, a lot of global macro funds, depending on the fund, right? Like most of these have a bullish component. So when you run the correlations versus the market in a lot of strategies, they're, 0.8, 0.9, right? So one of the lessons from 2008 was everybody was sort of surprised how much things correlated, and very diverse institutional portfolios wound up getting obliterated across all sorts of different asset classes. So as an investor, like I sort of think about it from the standpoint of where do you have hidden beta, right, in the portfolios where most of the time it doesn't correlate, but if you do get into a more volatile downtrending tape, really might correlate pretty significantly. And I think that's the biggest allocation decision to start with, is how much do you want in really truly uncorrelated alpha products, and how much do you want in things that are uncorrelated most of the time but are really bullish bets in one shape or form.
Do you think that hedge funds should be generating losses in months like October? We've been hearing for weeks, months, years, just hang tight, stay with us, when there's some volatility in the market and a downturn, you're going to need us, you're going to want us, and then we see numbers like we saw in October. Just to give you a sense, according to HFR, which we can debate is, the validity of these, but just for argument's sake, long short down about 4%, event driven and macro down 2%, relative value down a little more than 1%. By comparison, the S&P was down 7%, but government bonds, corporate credit were down about 1%. Should we be expecting more wealth preservation in the market in a month like October?
I think you shouldn't be looking at the performance of hedge funds in aggregate. I mean, I think the difference is, what is the beta? There's differentiation. It's like talking about all funds, all mutual funds. You could have a bond fund, you could have a gold fund, you can have all different funds, and there's this big category of things. And I think there's a lot of beta, long beta, built into a lot of hedge funds. And the important thing is to differentiate one from the other. Find the ones that have a negative beta or no beta. Well, and I don't think any fund should have a beta. In other words, because you're supposed to be producing alpha, so you shouldn't have a beta. So I think when you're looking at it, if you keep looking at the averages, and those funds continue to have the beta in them, then they're going to be of not much use in a bear market. So I think the important thing is to differentiate them. I think the world is long beta. The world is long because what happens is you're in a situation, first of all, that you have a bull market. So if you didn't have the beta, people think we want the beta, because at the end of a market, everybody wants whatever went up a lot, and you've squeezed out of that. So how many short sellers are still alive? Not many. And so you're in a situation where I think you need to know the structure of the particular fund and create differentiation. And I think that's a problem in the industry. Not only this industry, but I think, let's say if we take indexing and ETFs and so on, there is a chance that it becomes self-reinforcing, because when you get a down move, I don't think there's going to be much to protect investors against the down move. I wonder, just here, how many of you investors don't have a beta in your portfolio so that you're long? Okay, no hands went up. So this group, and I think it's representative, is long. And the world, I'm saying, is leverage long. Because it's this incentive. Borrow money and buy stocks. That's what caused the stock market to go up. All the buybacks, you change the tax cuts, and then you say, who's been the buyer of stocks? Because interest rates have been low relative to equity, return on equities. It's been paying to buy back on a leverage. So the whole world, I think, is leverage long. And I think that's also true of a lot of the hedge fund industry, and that's the big question.
Lindsay, we keep a lot of data on the hedge fund industry and look over long periods of time. And I think what we're seeing is that there dispersion within the same category of hedge funds, that have no beta, or the ones that, if you're long short, you by definition have some beta. Within each category, the dispersion has become huge. The other thing that you're seeing is that there are very, very few hedge funds that over long periods of time, looking, again, 5 years, 10 years, not every year, but over long periods of time, have outperformed some sort of an absolute number. So I think it is one thing that maybe the hedge fund industry needs to do moving forward is have another discussion about what is the objective and what is the benchmark. Because if the benchmark is it used to be some absolute return, T-bills plus 3%, 3 bills plus 5%. Some sort of absolute return, so that if you were using hedge funds, let's say for your university endowment or for your children's education or for a pension fund payment, there would be some absolute return to pay your pensioners, not just a relative return relative to HFRI, which doesn't mean very much. So I think moving forward, people are looking for going back to that sort of what is that number, composed of some element of beta, some element of alpha. And then if it is beta, how much am I paying for that beta? Because there's no point paying 220 for the beta, but certainly worth paying a lot for alpha that is not based on just market movements. So I think the discussions in the industry will become much more interesting, and I hope that more people will do more research on what are meaningful benchmarks.
Now, Blackstone's Byron Wien recently noted that about 60% of equity trading is now conducted via machines or algos. Stan Druckenmiller says the algos have taken, quote, the rhythm out of the market and have become extremely confusing. Are we going to be feeling the effects of these, whether it's ETFs that are passive instruments that are allocated largely based off of computers, algorithmic trading, and so forth? Are we going to be feeling more of the effects of these instruments as liquidity is taken out of the system? Is that kind of what we're starting to see over the last few weeks with regard to the market gyrations?
Yeah, I mean, you have more professional money in the markets, right? So I think this is one of the classes where it just creates both risks and opportunities, but in general contributes to the crowding overall of professional money. So 15, 20 years ago, you had a lot of retail money trading in the markets, right? Like that's a good opportunity set to trade against. Then you had a lot of mutual fund money that was not particularly sophisticated in how they executed orders and how they entered and exited things. That's a good thing to trade against, right? When you have all algos, and a lot of them are from folks that are fairly sophisticated, right? That's harder to trade against, right? Now, it does create opportunities if you can get a sense of the momentum shifting in these things, but it's definitely just a more efficient market, and it's also less discretionary participants from both the sell side and the buy side that are creating the liquidity.
Yeah, I think that the term algorithmic trading or artificial intelligence is not very clear and very specific. So I think what I'd like to clarify, you could almost say, when you say algorithmic, it's like saying, if I use computers in my decision making, am I going to be better off or not? Well, it sort of depends on how you're using computers. If you don't use computers in your decision making, that's like being in an era where there's the abacus. Mm-hmm. So the question, I think, is where the algorithms come from. Like in our particular case, what we've done for 25 years or so is to write down these principles of how we would, specific criteria for making decisions, and then we would convert those into algorithms or equations, as we called them back then. You write down the rule, and then by getting that rule written down, which is a reflection of your understanding, we've been able then to test how that would have worked in different countries, different time frames, and then we've been able to take those rules and say, whenever these conditions exist, come in. And we've been able to automate our decision making, which means really there's deep understanding. And then by being able to take the deep understanding, like programming a computer chess game, let's say, and now you have that computer that's helping you, it's been invaluable for us over the years to be able to take that deep understanding, but also process it quicker, do much more capacity to do the analysis than the brain would be able to do, because we can analyze by those criteria so much. And then we'll also be able to do that promptly and unemotionally, and that has been a tremendous, tremendous asset. And so I would say 98% of our decision making is in that way, operating in parallel with the mind. So it's like playing chess with your mind, and then playing chess with the computer that you've built to play chess, operating simultaneously. And when you're doing that, you're thinking, oh, why did it make that move? And why did I make that move? And how do I reconcile it and build it? That's tremendous. There's a lot of also tremendous decision making in order execution in trying to find out the imprecisions and so on. I think that algorithmic decision making, on the other hand, could be very dangerous if there's not understanding. So it depends where the algorithm comes from. And this is true beyond investment business. But if you're in a situation where you have machine learning, and you say, okay, go in there and analyze and come up with the equation, the algorithm that I'm going to bet on in the future. And if you don't have deep understanding, and the future is different from the past, that's a formula for a disaster. And that's particularly true in the investment area. because in investments, we've seen styles, you know, like merger arbitrage or any particular style that comes in, and they say, oh, that's the thing that works. And in the investment area, if everybody discovers it works, it won't work. It'll actually lose you money because the market will then cause the buying, and that buying will be reflected, and then something becomes overvalued and it works the other way. So I think that algorithmic decision-making and machine learning is a tremendously beneficial, powerful tool if used well, and I think it's a very dangerous tool if you're careless with it. And I think that nowadays, I think a lot of people are being careless with it.
The key is understanding.
I'm just going to add, Leslie, this last month, the so-called AI funds did not do well. But at the same time, these are all based on humans, right? So we are teaching them. And as they are learning from us, they will need a long period of time to become useful. But it doesn't mean that what is also interesting, by the way, is one is sort of just using these tools for trading, which is what you asked. Two is using them in our businesses. And that use, I think, is becoming much more prevalent and very helpful. Let's say when you're looking at large masses of data across many, many thousands and thousands of hedge funds, what we're seeing now is that AI-generated information is much superior to human, just because our brains cannot process so much data. And then finding ways to visualize that data can be quite cool.
I feel like we could continue this conversation for another hour, and I know you all would sit and listen to it as well. But unfortunately, I'm getting the hey, Leslie, stop talking now hand wave over there. But I just want to thank all three of you so much. Those were really, really interesting comments.
Thank you.